Welcome back to the Financial Freedom Show. My name is Rob Berger. In today's video, we're talking about 7 really important lessons we can learn from the GameStop saga. As you no doubt know, the stock price soared to above 400. It's since crashed. It was down by 60% yesterday. It's now under $100. It's closed yesterday at $90. It may be up a little bit this morning. Let me actually show it to you on the screen. This is the stock here. You can see this is a 1 month view. I mean, it's just crazy. You go back a month ago and it was around 17, 18 bucks a share. It hit its high water mark around, let's see here, this was over $400, I think, or $396. It's since crashed down to about $90. We can look at it even just 1 week and you can see the incredible volatility. Yeah, it actually did get, I guess it did bounce up over $400 at one point. Just remarkable volatility. Obviously, a lot of press, and there's a lot of things we can learn as investors, as long-term investors trying to build our wealth. There's a lot of things we can learn from the GameStop saga. I want to walk through them very quickly. There's 7 of them. The first is, in the short term, fundamentals often don't matter. By fundamentals, I mean the actual, value of the company based on its balance sheet, its income statement, its profits, its cash flow. In the short term, the price of a stock can become completely divorced from the fundamentals of a company. It happens with large companies as well, not just small cap stocks like GameStop. I've seen it with Apple. I've seen it with Berkshire Hathaway. You see it with well-known companies where the market somehow goes astray from the fundamental values. It's actually why I first began investing in Apple. This was back in 2013. On a split adjusted basis, the shares, well, before splits, they went from like 700 down to below 400. After splits, it was about $15 a share. And it became totally divorced from the fundamentals of the company. Of course, it was undervalued then when I bought it. GameStop, of course, at over $400, frankly, even at $90, is overvalued, I think, by anyone's estimate of GameStop's true value. But the real key is to understand in the short term, stocks can become divorced from fundamentals. The second thing we could learn, though, is that in the long term, fundamentals are the only thing that matter. Stocks will return at some point, eventually, to the intrinsic value of the company. It's one of the reasons Warren Buffett says that in the short term, stock market's a voting machine. In the long term, it's a weighing machine. In the short term, all kinds of things can affect the actual price of a stock that have nothing to do with the fundamentals of the company, but eventually the price comes back either up or down to the fundamentals of the company. We're starting to see that in GameStop, but frankly, even at $90, it's significantly overvalued. And who knows what to happen today or in the coming weeks. It could go up again. But we have to remember, as long-term investors, eventually the price is going to mirror the fundamentals of the company. The third thing we can learn, perhaps maybe the most important in my list today, is to understand the difference between luck and skill. And whether we're talking about investing or business or career, I think anyone who's had some level of success, part of it has been luck, and I certainly will include myself in that. And by luck, all I mean is sort of unexpected, unforeseen good fortune. That's really all luck is. Some view it as a bad thing. We want to believe that everything that happens that's good is because of our skill and our genius and our hard work. All of those things are important. Just because you've had some luck doesn't mean you don't work hard. Doesn't mean that you're not good at whatever you're trying to accomplish. Again, whether it's business, career, investing. But it's really important not to fool ourselves when it comes to distinguishing between the two. The reality is long-term investors in GameStop, we're talking about folks that invested not in the last couple of weeks, but in 2020, 2019, who really believe that GameStop can turn things around. And because of what's happened in the last couple of weeks have made a fortune, that was luck. That wasn't skill. And again, that's not a negative thing. But understanding the difference is really, really important. And perhaps the best way to show that is the fourth thing that we can learn, and that is you can't predict the next GameStop. See, when things happen because of luck, it's not something that can be repeated or predicted. It's like winning the lottery. Yes, you may win the lottery, and that's lucky. And I've known some big lottery winners, but I wasn't skilled. It's not something they can predict. You can't predict the kinds of things that happened to GameStop, certainly not long into the future. And that's an important lesson to remember. I've watched a lot of videos and articles online about folks saying, here's how to predict the next GameStop. Here's the next GameStop stock to invest in for the long term. It's all nonsense. And as long as we can distinguish between skill and luck and understand the difference, then when we say things like that, we can understand what they really are, which is just someone trying to get YouTube views or get an article to go viral. It's not something you can actually predict. If you've fooled yourself into thinking you can predict the next GameStop, it's likely going to be a very costly mistake. All right, the fifth thing we can learn is that short-term trading is at best extremely dangerous. That's true whether you're trying to short a stock. It's true whether you're buying and selling relatively short-term options. It's true whether you're day trading, swing trading. I've yet to meet someone who consistently builds wealth over the long term doing some form of short-term trading. I've certainly never met anyone that can beat the long-term average of the stock market, say by comparing it to just an S&P 500 index, for example. Some folks get really lucky. And if they get lucky and then get out of the game, they can make a lot of money. But most folks, kind of like gambling, they just don't do it. And now, unfortunately, a couple of weeks ago, the story was all the millionaires that were made from GameStop stock. Now that it's crashed, the story is all of the people who've lost a lot of money. And frankly, it's heartbreaking. But that should be expected. That's what happens when you play this kind of game. All right, the sixth thing we should learn is don't follow the herd. And GameStop was a perfect example of the herd mentality. And following the herd presents a couple of problems. First of all, you're much more likely to join the herd too late. It's the really early investors, before there was a herd, that actually have the potential, if they get out at the right time, to make some money. Once there's a herd mentality, it's likely too late to make a lot of money. But the second problem is, if you're following the herd, how do you know when you should get out? Let me show you this on the screen. Here we go. This is from the Reddit forum, and this was a post earlier today. Who of my 300 brethrens are still in? And there's a lot of folks on the Reddit Wall Street Bets subreddit trying to rally the troops. Don't sell, hold tight. Now, of course, there's already been a lot of high-profile Redditors who've already sold out. And that's the problem. This herd, and that's what it is, isn't going to last forever. And people are going to get picked off one by one because they just can't handle the volatility, or maybe they just want to cash in and if they've got any gains left and keep what they have. But at the end of the day, you really can't follow the herd. You've got to do what's best for you. All right. The seventh thing is, I think it's important to invest to build wealth, not to hurt somebody else or to make a point. And I get the David versus Goliath. It's a great story, but trying to hurt a hedge fund, well, a lot of folks are already finding out it's very costly. And to me, that's not really the point of investing. Obviously, we each have to make our own decisions for ourselves. And if you want to invest in ways that you think will, stick it to the man, so to speak, by all means, go for it. I don't think that's a great way to build wealth. And so I tried to keep my politics out of my investing. I keep my religious views out of investing. I'm trying to invest in smart ways that over the long term can help me build wealth. If you start getting into trying to make a point or to hurt this person or that company, I think you just have to know going in, it could cost you a lot of money. So GameStop, it's taught us a lot of lessons, and maybe it'll teach us some more yet to come. But those are my 7 big takeaways from the GameStop saga. What are your takeaways? What have you learned? Leave them in the comments below. Thanks for watching. And until next time, remember, the best thing money can buy is financial freedom.